home sales statistics, affordability index, and home buyer and seller profile report. He regularly provides commentary on real estate market trends for its 1.4 million realtors. Dr. Yoon creates NAR's forecast and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. And we welcome you, Dr. Yoon. Thank you so much for joining us.
Thank you, President Donna Littlefield, for the introduction. Hello, Buffalo Realtors. I think the last time I was there, maybe it was 3 years ago. So once the economy reopens and we can safely retravel, we will try to arrange so that I can visit that beautiful place in upstate New York. So it is a very tough times, a lot of uncertainties, but also some factual information that we need to be cognizant of. So facts are facts, and let's see what the data indicate. So I'm going to try to upload my PowerPoint. So I'm going to do the share screen. I've been doing this Zoom for many presentation and getting much more comfortable at it. So let me just pull it up. Okay, so here we are. So the economy was doing quite terrific before the pandemic. And for leadership of Buffalo Association, last year, you would have visited Washington at this time of the year in May, about 8,000 realtors across the country coming to talk about what's happening, along with talking with the elected officials, members of Congress. We always invite the sitting president to address the realtor audience, and President Trump last year accepted, and he ran off many of the positive economic data. I know that President Trump can be divisive at times and prone to exaggeration, but the economic data that he was running off were right on the mark to say it was the longest economic expansion, the lowest unemployment rate across all demographic category. So the economy was running quite fine. And in 2020, before the pandemic, it looked like another year of expansion, everything moving nicely before the pandemic. And things are turning very ugly quite quickly. So given this environment, let's try to see how things could develop. There are certainly many unknowns. We don't know the path of the virus. We don't know when the vaccine will be discovered. We don't know, or maybe perhaps we do know that social distancing can work. So there are a lot of things at play. The broadest measure of the economy, GDP, so which was the prior charts, and the first quarter number came out just yesterday. And here's what it looks like. So on the first quarter, it declined 4.8%. Anytime it declines of that magnitude, it would be considered quite severe. The second quarter would be absolutely awful. So the month of April, May, June, the number that will be coming out later, say in about 3 months' time, it could be something like minus 30% or minus 40%. I don't even try to make a call as to whether it's 33%. I think data is quite ugly. Then the second half of the year, every economist anticipate growth in the second half of the year, provided that many states reopen their economy. So it will be also very positive, off the chart positive numbers, but perhaps not enough to make up for the loss that occurred in the first and second quarter. But it is instructive to look at the first quarter number a little more carefully. So overall economy declined 4.8%. But what was the reason? Well, the consumer spending contracted 8%. Remember, the January, February numbers were positive, so that 8% decline is really coming from March figures. Same thing for business spending, it declined 9%. Housing sector was quite strong. So even accounting for the pause button in March, the residential investment, which include home building activity, home sales, spending for remodeling, grew at solid 21% in the first quarter to attest to the strength of the real estate market before the pandemic. The next line is the personal income. So income grew 2%. And look at the savings. Savings essentially more than double for Americans. So income slightly grew, but spending did actually fail. So what people are doing is people are simply saving money. Now, during the job losses, it is very tough for people, the uncertainty related to the job losses, income loss. But keep in mind the massive stimulus package bill, including the unemployment insurance. We lobby very hard to make it available for independent contractors. So the realtors would now qualify, along with, say, Uber drivers and other people who are self-employed. And at the minimum, it would be $600 per week. I understand that some states that don't have the computer system up and ready to handle the newly qualifying independent contractors, but once it's up and ready, it will be retroactive. So please keep that in mind, that it was no fault of the entrepreneurs why the economy shut down. It was a government-imposed lockdown. So during this disruption, please tap into all the resources that are available. So the people are saving a lot of money, which could mean that once the economy reopens, people have this savings amount to put it back into the economy. Or it could be that people become pessimistic and they just want to save and save more, which could then harm the economy as the money is not flowing back into the economy. But at least the potential for spending growth once the economy reopens is there because of the massive stimulus package bill. Now, for the job market in the greater Buffalo region, looks like the following. So one sees that it's been fairly steady and little seasonal patterns that's occurring with more jobs in the summer months versus the winter months. And you see in the middle of this chart that the 2008-2009 recession led to some job losses, but it was rather mild in the Buffalo region compared to rest of the state because housing market, even though there were foreclosures, it was not the massive foreclosures that you saw in, say, Florida, Arizona, or Nevada. So the market was relatively stable. And then from the low point in 2009, steady job creation. About 30,000 additional jobs compared to that low point in 2009. Now, this is the ugly picture. This is the people who are currently receiving unemployment benefits. So you see that, typically it's about 2 million Americans who are receiving unemployment benefits. And then when the economy shut down from mid-March, you see the numbers just ratcheting up very, very fast. So you can say these are total cases of the unemployed. And the amount is, the spirit of the unemployment insurance or the current enhanced unemployment insurance is to say, Americans were working hard, entrepreneurs were making the right decision, government imposed the lockdown, so people should not lose so much of the income. So the income replacement from the unemployment insurance in spirit is such that most people are back up in 100% income replacement. Now, for some people, it could actually be a little higher because you think about cashier working at a department store was making, say, $12 an hour. The current unemployment insurance benefit would be higher than what they were making as a cashier, while the majority of the people, the income replacement is still insufficient to make up for the business activity that is lost. But the government spirit is, quite generous in terms of trying to make it whole on average. Some people are a little better off, other people are worse off in the current environment, but this certainly raises at least the uncertainty about the direction of the economy. Now let me turn to the next slide, which is not the total unemployment filers, but the new cases. How many people are filing for the very first time? So if I was to use the analogy of the coronavirus, sometimes in the evening, almost every day, they talk about how many new people are infected with the virus. At least it's showing at least declining patterns, which means that total cases will not rise dramatically in the upcoming months. So at least there is some level of sort of decreasing cases of new people who are filing for unemployment insurance. This is the state of New York. So you see that in mid-March, it increased, that suddenly by end of the March, just, way, way off the chart. 400,000 New Yorkers applying for it. And then in the past couple of weeks, you see much less number who are filing for the first time. Again, these are new cases. You need to decrease the new cases in order to contain the total number in the future. And the Erie County looks like this. So again, very similar. Towards the end of March, 25,000 people file. The following week, about 15,000. But the most recent week is only 10,000. So at least the number of new cases are beginning to decline, which means that in say 4 or 5 weeks, maybe the total cases will top off. And as the economy steadily reopens, people come off the unemployment roll and they go back into the job market, the total cases will decline. When the economy reopens, certain businesses would be up and running 100%, I believe. Say hair salon business, dental care, or even daycare centers, because children are somehow immune to this coronavirus. And it's possible that daycare center could be up and running almost 100% immediately. Other businesses like the cruise ship industry, it could take multiple years, or airline industry, unless a vaccine is discovered. So everyone is just crossing their fingers that vaccine could be discovered this year, and we're all back to normal. Even the air travels and everything will be back to normal, but we just don't know the path of the virus and when the vaccine will be discovered. Niagara County shows the following, again, very similar trends in terms of sudden surge and then number of new cases of unemployment filers beginning to steadily decline. Let me look at these two cities. One is New Orleans and other is downstate New York City metro market. And it is not Buffalo, but it provides some comparison or potential comparison with today's conditions. I mean, nothing is a perfect match, but at least we can get sense something. So in the New Orleans chart, this is the unemployment rate. You see that unemployment rate was around 5%, 6%, then suddenly shot up to 16% before declining. What happened? Hurricane Katrina. When Katrina hit, flooded the city, the people who were in the travel industry, restaurant business, all shut down. So unemployment rates quickly shot up. Then why did it decline? Because of the massive disaster relief funding that went into the city. So once the spending went into the city or the disaster relief, at least it stabilized the market condition quite quickly. Now let's turn to the New York City. The large bump that you see, that's related to the subprime market bubble crash. Lehman Brothers went under the Wall Street crash back in 2008, 2009. But the first hump that you see, more milder hump, go to 2001 September 11th, that horrific events that occurred. So the unemployment rate went from 4% to 7% very, very quickly, as people were very fearful. If you go to a restaurant, will there be a bomb? So there was a lot of fear pervading throughout the city. And then it stayed up there, but massive disaster relief funding went into the city, but steadily the unemployment rate went down again before the subprime market bubble and crash that led to higher unemployment. So what I want to illustrate here is that at least when there is a major localized disaster, and when there is a sizable federal funding that goes into the city, it tends to stabilize the market. And in fact, in New Orleans, home prices actually rose the following year. New York City, same thing, home prices increased after the September 11th events. So if the money goes into the city in a massive way, it can quickly stabilize the market. Now today, nationwide coronavirus impact, massive stimulus spending bill. So perhaps it's possible that we may come out of this in a reasonably decent fashion. Again, the cruise ship industry or even auto purchases, I think the Buffalo, there are some manufacturers who supports the auto industry. It may take a little longer to recover, but the spending power, people are saving their money. So let's see how things develop, but at least New Orleans and New York demonstrated that they can recover after that quite a heavy hit to the local market from the disasters. In the meantime, housing sector was moving along very nicely. And so this is before the pandemic. So from the low point in 2009, so this is during the foreclosure crisis, the home sales steadily increased with jobs. It's not increasing like what it had been in 2005, thankfully, because we don't have subprime lending. And that's one big factual difference today versus back then. Back then, we had wide prevalence of subprime lending, people overstretching their budget. Suddenly, mortgage rates readjusted, adjustable rate mortgages, and people were paying, say, $700 mortgage. Now they have to pay $1,000 they cannot pay, and it went into foreclosure and then led to the economic downturn. We don't have that subprime mortgage anymore. So people are meeting the credit standards, staying within budget. So that's one big difference. Second big difference is that back then, 2005, 2006, home builders went wild. They overproduced. They produced way too many homes. So we had an oversupply situation. In the Buffalo market, as in the rest of the country, if there was one challenge in the recent housing market was lack of inventory, especially on the mid-price homes or below. So lack of inventory, completely unlike the situation of oversupply by the builders back then. So when someone asks, are we going to face another foreclosure crisis? Your answer should be, well, let's compare the facts. One fact is, back then, too many funny mortgages. Today, we don't have that. Second, home builders produce way too many homes. Today, they have been underproducing and we have an inventory shortage. So we had an inventory shortage before the pandemic. And here's the chart on the overall nationwide inventory. And I'm sure that you are more familiar with the Buffalo market. But the inventory level at historic low. So what's happening currently during the pandemic? Well, during the pandemic, we have even fewer inventory. Well, there are fewer buyers, but at least on the inventory side, there is even greater shortage for at least some serious buyers who may be attracted by the current exceptionally low mortgage rates. And they said they're not excited about the current inventory shortage. So as the economy steadily reopens and more inventory begin to show on the market, I think the buyers would then get more excited. Unemployment is a problem, but keep in mind, 70% of Americans have secure employment. They are looking at low mortgage rates. They just need more excitement on the inventory side. And also for the sellers, when we take survey of the sellers, they are saying that home they were planning on listing, they are going to postpone for a couple of months until the economy reopens. So as the economy steadily reopens, certainly more listing will come, and probably about 80% of those listings are for the reason to purchase, meaning that people are putting their homes on the market so they can relocate to different parts of the city or a larger size home, maybe different school district. There are a variety of reasons. So listing just simply does not mean supply. It also means demand. As more listing comes, there's more demand for home sales transaction activity. So this is the first month where we are sensing some impact from the pandemic. So in March, pending contract nationwide declined 21%. And in April, I anticipate even much lower number before some recovery in May. I'm hopeful as the economy begins to reopen, but we have to wait and see. I know that in Pennsylvania, it's a total lockdown. So things are down about 80%. You know, people cannot make a physical visit to any homes. But in Virginia, where I live, people can visit homes following the social distancing protocol, and the sales are down more moderately. So Michigan and Pennsylvania down severely because of total lockdown, while in Virginia or in Georgia, it is down much less because at least people can view homes physically following the social distancing, sanitizers, masks, and others. And also we should just begin to think about, I mean, at least for me, we ran out of milk. You know, we have a son at home, my wife, so we ran out of milk, so I had to go to grocery to replenish. Put the mask on, to the normal, trying to keep a distance from other shoppers. But if you think about going to the grocery store, which we accept as being new normal, home buying is even safer. Just consider the number of people involved in home buying, visiting a home with all the doors open, lights on, compared to visiting grocery stores. So if people can visit grocery store, why is it that some states are not permitting to visit homes for people who are willing to put their homes on the market following the normal social distancing pattern? But nonetheless, we have to be safe. We don't want any increased cases of the virus because certainly the images that came out of the New York City, the ventilators, people hospitalized, those are just awful conditions where we don't want any of our friends and family members to be suffering through. But it is still, trying to balance that out between the economy versus the health risk. So this is the home sales. The shaded area shows the actual numbers. So in 2018, nationwide, 5.34 million. 2019, recently completed year, exactly the same, so no change. First quarter was running strong. It was up 5% on an annualized rate. And based on what I am seeing on foot traffic, what the realtors are indicating, the brokers are indicating, along with some economic modeling about unemployment rate, lower consumer confidence, the second quarter will look quite ugly, down 39% from 1 year before. When I said 39%, those are just what the economic models say. The actual number could be, say, from 30% to maybe 45%, something along there. In the third quarter, it will be down, but less severe because as the economy steadily reopens, some of the people who are furloughed, they're back on their job. Again, think about many small businesses, hair salons, they will be up and running 100%. Even restaurants, first month of restaurant business were down 100%, but now they're saying they are down about 60%. Now, being down 60% is not pretty, but at least it's an improvement from down 100%. Because people are understanding takeout orders are fine. So even one does not have to sit down at a restaurant, people are doing more takeout orders. And then by the fourth quarter, we are beginning to reach back up to 5 million. And then 2021, I think the momentum will carry and will turn positive at that point. Mortgage application to buy a home is also showing some encouragements. So in the last week of March, first week of April, you see that it was down about 33% from 1 year before. But look at the latest week, it's down only 20%. So again, showing some level of calming down that people are saying maybe social distancing, I can view homes. So people are becoming a little more comfortable. It is down from 1 year before, but less severe than before. So somewhat encouraging direction on the people who are filing for mortgage applications. In the meantime, the Federal Reserve is all in. They lowered the interest rate down to 0 all at once, and they are pursuing something called quantitative easing. Essentially, they're opening up their facility to buy bonds, whether it is government bonds, it could be the state and municipal bonds, maybe the mortgage market bonds, to keep the interest rate very, very low. And the impact on the mortgage rate is the following. The red line is the 10-year Treasury yield, and the blue line is the 30-year fixed rate mortgage, average rate. You see that two lines move almost one-to-one, synchronized movement. If you look at the last data point, what you see is that 10-year Treasury is much lower. So that would imply that mortgage rates today at 3.3%. In fact, Freddie Mac said yesterday that we have officially hit an all-time low at 3.3%. But in my view, it may even go down further to even 2.8%. That is a possibility, not a guarantee, but distinct possibility based on where the 10-year Treasury yields are. Now, one of the reasons why the mortgage rates are a little above 10-year Treasury, larger gap than normal, is that refinance demand is very strong. So once the refinance demand begins to taper off, then the interest rate may come down a little more. The mortgage rates may come down more. But I would also caution that the jumbo market is not working. But in the Buffalo region, I don't think jumbo mortgages are not that of a big factor. It doesn't have a government guarantee, and hence to get a jumbo mortgage, one has a 20% down payment, pristine credit scores, much difficult to obtain loans. But those mortgages, whether FHA backed or from mortgage brokers, from consumers, they don't know the working of Fannie and Freddie. They are just trying to get a mortgage. But from mortgage brokers, if they can sell that mortgage to Fannie and Freddie, then 5% down payment, 3% down payment, normal credit score should be sufficient to obtain mortgages. I mentioned about the housing shortage. This housing shortage will not go away anytime soon because the red line is the historical average. And you see that the builders overbuilt back in 2005, 2006, and then they have been underproducing for almost a decade. And that is why we have that inventory shortage across the board. In Buffalo, Cleveland, everywhere, inventory shortage. And in the first month of the pandemic, builders actually built below the red line. So we may continue to have this housing shortage, which means we need more listings, but also from your buyer's perspective, they should not anticipate any major decline in home prices. I think the prices will hold steady, and at least the prices were running quite strongly inventory shortage, and we still have inventory shortage. Let's look at the coronavirus impact. We've been doing some survey of realtors about their clients or potential clients. And here is a question about prices. The sellers on the right-hand side is easier to understand. Home sellers, are they reducing prices now compared to pre-pandemic or what they thought their home was worth? And 72% of the sellers are saying no. They are just remaining calm. There's no panic among sellers to reduce prices. So very, very calm activity. And if you say less than 5%, you include that, the figure reaches almost 88% of the sellers saying they will hold on to the prices. What about the buyers? Well, the buyers naturally want some discounts. So they do anticipate some lowering of the prices, but 37% actually said they don't anticipate any lowering in the prices. Maybe they went through that multiple bid process before the pandemic. They know how difficult it is. So maybe they understand the reality of the market of housing shortage. Another 16% said by less than 5%, but that is quite normal. It is very rare that a buyer wants to offer a listed price, 100%. They usually go slightly under, 98%, 97%. So you may say that's normal. So that means that half of buyers anticipate normal pricing. Then you have the other 40% or so who think that they can get a lowball offer accepted. Well, good luck to them because the shortage of inventory is implying that it's going to be very tough. And also, we don't have foreclosure inventory reaching because of the mortgage forbearance. So people who are facing economic hardship, talk to the mortgage servicer. Maybe this is a great opportunity for realtors to reach out to your past client to say, if you lost a job, you can skip out on a few months of mortgage payments. Now, if it is a balloon payment, you have to repay all at once. That should not be the case. So try to negotiate with mortgage servicer to make it that whatever missed payment should be simply tacked on at the end of the life of the loan. So rather than being a 30-year mortgage, now it becomes a 30-year and 6-month mortgage if a person somehow missed out on 6 months of a mortgage payment. So it's the same monthly payment, but it's just simply being pushed out a little further. If somehow your past client need to sell their home and they missed out on a few months of payment, it simply means that they have less equity once they sell their home because they're missing out on their mortgage payment. People with jobs or people who are getting this enhanced unemployment insurance and their overall finances did not change all that much. They should be paying mortgage payments. It's in their interest. Keep paying, build equity from it. So home prices in Buffalo, steady increase. And you look at this historical chart, it's quite amazing. Back in the year 2000, typical home in Buffalo was $80,000. Now it is double to $160,000. It is very, very affordable by, say, New York City standards, or most other city standards. I know the property taxes are a bit high, so that's a discouragement. But for people who may be saying, I am tired of this high density living in the city, and they want to live, get a larger house out in the suburbs, maybe we are doing this Zoom conferencing. Maybe people become much more comfortable about working at home. More companies offer working at home, which means that, well, maybe they could live out in the Buffalo suburbs. So, you know, this is certainly a very affordable market where you are residing. And the stimulus help, again, the spirit is to replace lost income, small business administration loans. I know it's a headache trying to get it approved, get the paperwork, but keep at it because, again, the spirit is these loans, if you meet certain criteria, simply becomes grants. You don't have to repay. So for brokerages, the unemployment insurance, minimum $600 on average is about $1,000 per week, which is like $4,000 per month for people who are unemployed on average. Mortgage payments could be delayed, foreclosure freeze, and the quantitative easing. How is the government getting all this money for massive federal stimulus, unemployment check, and so forth? It is running up a huge deficit, off the chart deficit. How are they financing? To make it very quickly, simply it is printing of the money. Federal debt that the Treasury is borrowing. So it's the printing of the money to finance the unemployment check, stimulus bill, and others. Now, in the current environment, I would say it is very appropriate to do that. We want income replacement. It is not the fault of Americans as to why they don't have jobs. So it is very appropriate policy. However, if there's so much printing of the money, doesn't Econ 101 textbook say, print money, you get inflation? Well, America is in this extraordinary privileged situation of having the US dollar. Because we have the US dollar, we can print money and not have inflation, at least in the short term. So maybe no inflation this year, no inflation next year, but one has to think, if you print so much money, maybe inflation 5 years, 6 years from now. Some of you may remember the 1970s when everything was rising at 10%. You go to grocery store, 10% higher. Next year, everything is 10% more. So we had inflation. So if we have inflation, people want to hedge against inflation. How do you hedge? Some people want to buy gold as a hedge against inflation. But real estate has also provided a very good hedge against inflation in the past. And just consider, say someone who has a secure employment today buys a property today, that monthly mortgage payment is fixed for the life of the loan. 5 years from now, 6 years from now, when there is an inflation, well, certainly there's no inflation in the mortgage payment. While their home values may be rising as a hedge against inflation. So it will be a great opportunity for some who have secure employment, who are willing to stay within their budget to go ahead and buy now at the historically low mortgage rates. And 5 or 6 years from now, when the inflation happens, rents will be rising and the mortgage rate could be higher at that time. But people who are locked in today, their mortgage payment will be fixed, not rising 5 or 6 years from now. My final slide is the forecast. The caveat is the label economic forecast, highly uncertain. Again, a lot of unknowns out there. So in 2020, because we are facing very difficult second quarter, the GDP, I think, will be down by 4.5%, independent of however positive we are in the second half of the year. That will correspond to about 4 million job losses total. Which means that you hear about 30 million people filing for unemployment insurance, but some are finding jobs at Amazon, Costco, other jobs. But as the economy reopens, there will be more jobs recovery. Hair salons, daycare centers, dental offices, cancer treatment, all that jobs will begin to recover. Prices holding on. There's no panic among home sellers. We have a housing shortage, but because we missed the spring buying season, sales will be down about 10 to 15%. And you may say, given what we went through, maybe unit sales going down 10 to 15%, even with second half recovery, you may say that's not too bad. That in 2021, everything turns positive, GDP positive, job gains positive, prices positive, and unit sales possibly about 15% growth next year. So with this, please hold tight, keep your family members safe. We will get out of this, hopefully sooner, better than later. But we hit a pause button. It's challenging times. Please utilize all the financial resources the stimulus package is providing during this disruption. So thank you for listening. Thank you very much.
We all set there, Peter? Can you hear me?
Yes, I
Awesome.
muted you. Yep.
Thank you so much. Some very, very good news amongst the COVID virus bad news. We got to hear some great uplifting news on housing and the economy coming soon. Thank you, Dr. Yoon. That was fabulous information. We appreciate your time. We're going to open the door to a couple of questions, and I believe there are a couple in the chat room right now. Sharon, can you read the questions, please, so I can pull that up?
Okay, first one. I heard that banks are not accepting FHA and VA loans right now.
Very good question. If they are not accepting VA or FHA, then it is very problematic. It is going to delay the housing market recovery. It's going to call for the first-time buyers and veterans to access that. I believe that it could be certain banks and not all banks, because some banks, they are saying they are short on staff because of the refinance demand. But Veterans Affairs, FHA, it has government guarantee. There's no risk on the part of the lenders. And therefore, there's no reason why they should not be providing that. So if one bank or one lender is not providing it, please check with another lenders, because it should not be the case. But if it is, and I hear from more realtors across the country that is the case, we will talk with the policymakers to say, this is what we are hearing out in the field, and so they can address what the bottleneck could be.
Awesome. All right, great. I got this, Sharon. Thank you so much. The next question is from Gary Kenline. Does the unemployment numbers include the incomplete application, which I am told is significant in New York State?
That I don't know for sure in terms of whether it is an approved unemployment insurance claims or people who are just simply filing. So whether it is approved or not, whether or not people are filing, and state by state variation. In some states, they were able to reprogram their computer to accept independent contractors very quickly. Other states, they're just going into this headache of trying to reprogram their computer system to make it available for independent contractors. So whatever is delayed, keep in mind, it should be retroactive. From the New York State perspective, it costs the governor $0. All the money, at least the $600, is coming from the federal government. So it's in the interest of the Governor Cuomo to get this money out to the New York residents, since it's not costing New York State a dime.
Thank you. From Patricia, I heard that banks are not accepting FHA and VA loans right now. Is that true?
I just answered. That was.
Yeah, sorry. Okay. Any numbers that say how many businesses have closed versus temporary shutdown that will affect the unemployed going back to work?
So it's going to be tough for some small business owners. They are thinking that, do they want to retry again? Or do they just say that, it's time to, it's a very difficult time because first, they were making all the right decision and the cash flow is not there. Some are able to tap into small business administration loans. And if somehow this virus impact lasts longer, Congress would have to approve another package, which then it could be delayed. In the meantime, you can have the small business owner in an insolvency. I mean, that would be the most unfortunate situation. But I would also say, like the restaurant business, I mean, even in a normal environment, it is always competitive. A good restaurant that you saw that opened 5 years ago, suddenly, even without the pandemic, it closes down because there was a shift in consumer taste. So like the restaurant business is always tough. So what I would say is that some small business owner decide to completely leave and that building, retail building remains vacant. I can assure you that 1 year from now, there's a different entrepreneur trying to use that space for different reasons, or it could be on a different restaurant. So temporarily, there could be a lot of disruption, but eventually, I believe that Americans, through their resiliency, entrepreneurial spirit, will begin to open sort of new economy that adapts to this, perhaps this new reality.
Awesome, thank you. From James, do you anticipate interest rates rising come fourth quarter 2020 to hedge against inflation risk with the $4.6 trillion injected by the federal government? How else would they attempt to hedge against inflation?
So in 2020, interest rate will remain low. And even 2021, interest rate will be close to 3%. In my view, no concern on inflation. So people still have plenty of time to find that right home that meets their budget needs or family needs. But it's really 4 or 5 years from now where there will be inflation. And when I say inflation, I don't even think 1970s style. I think it's more like 5%, 6% inflation. The Federal Reserve would like their ideal inflation rate is 2%. So going up to 5 or 6%, it makes them a little uncomfortable, but that would be the reality given so much printing of the money.
Great. And we will have access to the PowerPoint. It is being recorded. That's a question. How many buyers no longer can qualify?
Just from the job market, the people who are filing for unemployment insurance, many are people generally on the below average wage category. And we look the people who are, cashiers and others, their homeownership rates are very low to begin with, but maybe this is their temporary status in life. Maybe they wanted to save up money for down payment later to buy. But keep in mind, again, the unemployment insurance package, the fact that people are unemployed, those are awful, but there is a sizable income replacement during this disruption.
Thank you. So from Brett, thank you, Dr. Yoon, very interesting. Can you give us your opinion on second home market?
So after this, I will take one more question because I have to also prepare for the next one. So on the second home market, it's interesting because we know that vaccine will be discovered, whether it is in September or sometime in 2021. So once vaccine is discovered, we're back to normal. But one fundamental change that would have occurred during this COVID crisis is that people are becoming more comfortable doing Zoom conferences and others. So you may have more workers able to work not in offices. So able to work from home, maybe visit offices on more rare occasions, which means that on the second home market, maybe some people consider second home as their primary home if more remote work possibility. But also the stock market is our big driver of the second home market, and the stock market first crashed, now showing some recovery. So one has to look at the stock market because people who are buying second homes are typically with more upper wealth, high net worth individuals, and they are more reliant on the stock market situation. So one more final question.
Yep, and I'll kind of combine two into one because they look like they're the same question. How many buyers will be knocked out of the market because of higher credit score standards of 680 or more and investor fear? And is it credit score driven?
So in the so for non-FHA backed, non-Fannie and Freddie, so you are looking at about 40% of the market. 60% is government guarantee. Those mortgages will flow. and the credit score changes are very moderate if they're raising at all. But it's that remaining 40% where you are seeing dramatically increased credit standards, larger down payment. So we hope that this 40% disruption is only temporary. We have certainly brought the issue up with the Treasury. The Trump administration talked with the members of Congress. Congress is actually considering whether they need to pass a bill to help out some of the mortgage servicers. Remember about the mortgage forbearance? What that means is that if people are not paying mortgages because government said you don't have to pay mortgage servicer is not getting this money, but they still have to pay homeowner insurance, they have to pay the property tax, and they have to pay the mortgage payment to the investors. So they're getting this cash crunch. And because of the cash crunch, they're saying we don't have money to lend out more for mortgages. So we are trying to see how to address the mortgage servicers who are in this cash crunch situation because government said mortgage forbearance is now possible. So I mean, one easy short-term fix is they open a Federal Reserve facility for mortgage servicer short-term loan. So essentially, Federal Reserve provides loan to the mortgage servicers until people can pay mortgages later when the economy reopens, and then the mortgage servicer simply pays the money back so we don't have this mortgage market disruption. But thanks for commenting on that because those are the stories which we relate to the elected officials here in Washington.
Beautiful. Thank you, Dr. Yoon, so much for joining us today. A lot of good information, some uplifting information in a very scary time. Thank you again and stay safe, Dr. Yoon.
But thank you, President Donna, and best to you, everybody in Buffalo.
Thank you.